everyone, and welcome to the first ACCA F3 live online session with your tutor, Rajwana Udin. Now, a warm welcome to those of you who have joined me today. Hi, Samalina, how are you? I hope, I'm glad to hear that you're glad to join this as your first class. And just as a reminder to everyone that this is officially our first class. The previous week has been cancelled because I was extremely unwell, sad face. I had just flown back from Morocco and I don't think the food was very great. Well, my husband loved it, but the food was nice, but it just didn't bode very well with me. But thank you for joining me, and today we are going to be starting our fresh F3 financial accounting. So here is a screen telling you that this is the name of the paper. Financial accounting is different if you've done F1, it's different if you've done F2. This is a fresh start on those who want to be bookkeepers, or those who want to be accountants, account assistants, those who aspire to be auditors in the future. This is the beginning of your financial accounting career. And what we're going to be doing today is we are going to be introducing ourselves to the first 3 chapters, and then you will have a good idea of what financial accounting is all about, what we mean by financial statements, and then we will start to learn everything to do with double entry bookkeeping. Now, with you today in class, you should have 3 bits of documents. The first document that you should have with you is the live online study planner. Okay, the live online study planner. Don't worry if you can see June 17 or March 17, it doesn't matter. It's the same for all students. This study planner will give you a guidance on what we will do. So clearly our first session was meant to be on the 1st of February, but we can ignore that and say our first session's on the 8th of February. This is what we're going to be covering today, chapters 1, 2 and 3. And today we're going to be covering questions 3 and 11 from the sample paper. And here is the most important column of them all, the homework column. Every week I'll be setting homework relating to what we've done in class that particular session. So today we're doing chapters 1, 2 and 3, and I am going to be setting homework on chapters 1, 2 and 3. You've got questions from the sample paper, you have questions from the question bank, which is at the end of the class notes, and you have questions from the revision kit, which can be found on the Canvas platform under your e-materials book. Okay, so here you've got many questions to practice for homework. I expect all students to submit their question attempt via email or send me a message via Canvas, and I'll get back to you with feedback, and then it's a great way to test how you've done in class. So please make sure you have a go at all of these questions set for homework, because it's a good way for you to test whether or not you've understood what we've done in class. So that's the first bit of document you should have with you, the study manual. Here is my direct email address. So if you wish to email me, I'm more than happy to get back to you on that. So my name is Rajwana Udin. You can call me Reg, and if you would like to get in contact with me, that's my email address. The second bit of document you should have is the sample paper, which can be found under useful resources or something like that on the Canvas platform. I can't remember the link, but this sample paper is a very important piece of document, and I'm going to be doing majority of the questions in class from this and setting homework from this sample paper. And also you should finally have the class notes, which can be found under useful resources or e-materials or something like that. I can't remember what it's called. But this is the class notes. Here in this document you have all of the chapters, the exercises, the notes needed to be successful in the F3 exam. Okay? So this chapter or this document consists of, let's see how many chapters you can see. It has, I'll have to zoom out a little bit, but you can see that we have 19 chapters to cover, and you have the solutions to the examples. So the examples in every single chapter, you've got the answers to them so you can rework through them in your spare time. And at the end here, we have the question bank. So remember, when I set homework from the question bank, I mean to look through the questions at the end of the class notes. Okay, so I've set homework questions from there. Homework questions set from the class notes question bank. Now, we are going to be doing the first 3 chapters today, and before we look at the start of each chapter, I'm going to talk a little bit about the exam structure. Your exam is a CBE exam, meaning it's a computer-based examination. And it's going to be consisting of questions which are multiple response. What we mean by multiple response, we mean selecting from options A, B, C or D. Okay. We have data entry, meaning you'll have empty boxes and you'll have to manually enter the answer yourself. You will have selecting answers from a drop-down list. Okay, and you will have questions which require to drag and drop. Whoops. Drag and drop. Okay. Also, your exam is going to be 50-50 calculations and 50% of theory questions. So 50% calculations and 50% theory. So theory is equally as important as doing calculations. Your exam is structured into 2 sections. You have section A and you have section B. Okay. Section A will have 35 questions, and each question is worth 2 marks. So that's 70 marks. Okay. And these 35 questions are covered by chapters 1 to 19. So every single chapter is going to be tested in section A. Section B, however, will have 2 questions, and each of those questions are worth 15 marks. So that's a 30-mark total. Now these 2 questions are case study questions, so it's based on one company where you'll have to answer little mini sub-questions, okay? And questions here are covered by either chapters 14, 16, or 18. So it emphasizes on chapters 14, 16, or 18 in section B. So there you have it. You have your exam structure. Section A and section B. So the whole exam is 100 marks in total. But to pass the exam, does anyone know what we need to get? In order to pass the exam, what percentage do we need to get? Well, for those of you who don't know, you need a 50% pass. Yes, thank you. So some students ask me, Reg, is it okay if I learn half of the topic, half of the course, because that half is going to come up? Absolutely not. You need to know 100% of the syllabus, because any of these syllabus areas can be tested, and you need to gain 50% in order to pass. So there you go, ladies and gentlemen. Here you have information about your exam. And if you do have any further questions, then please feel free to email me or ask me in the chat box below, and I'm more than happy to help you. So thank you guys, that's an introduction, and very soon we're going to start on chapter 1. Thank you. Okay, so we are going to start on chapter 1. Now chapter 1 has around 1 or 2 questions in the exam. Okay, could be 1, could be 2. And it's an introduction to financial accounting. Moreover, it's talking about the difference between sole traders and shareholders. Okay, the difference between sole traders and shareholders. So whenever you're ready, ladies and gentlemen, let's turn over to the next page and start chapter 1. We start off by defining what is financial accounting. Financial accounting is necessary because accountants keep records, they keep accounts. If you have a business, or if you know someone who has a business, or if you know of a business or a company, many financial transactions happen on a daily basis. So it's up to accountants to keep a record of these transactions and then try to summarize to what these records or transactions actually mean. So accountants record, they analyze, they categorize, and finally summarize financial transactions. Okay, so businesses have many transactions. They buy goods, they sell goods, they pay suppliers, they pay wages, they pay for their bills, they pay for tax, they pay loan interest. So many things happen in a business on a daily basis. So it's up to the accountant who works for the business, or it could be an accounting firm that does the accounts for this company, to analyze and summarize these transactions so we know where the money is going, how well the owner of the business is good at keeping control of the money, and if we're making profits or if we're making any losses. So recording financial information, we record the information in daybooks or ledgers. So daybooks are where we keep a record of financial information, and ledgers is where we use debits and credits. Okay, and we'll look at debits and credits in this session today. Once you've finished recording all your information, we then present the information in such a way that the users of this information or the owners of the company can understand what has gone on. And we present the information in something called statements. So we have the statement of profit or loss, which shows the profit or loss of a company. We have the statement of financial position, which shows the assets, the liabilities, and the capital of a company. We have the statement of changes in equity, which shows if the company has sold shares, if they've paid any dividends. And finally, we show the statements of cash flow, which shows how the company has generated cash and where the cash has been spent. So financial accounting is all about this process, the process of recording and then summarizing the financial information and presenting it onto statements. That's what accountants do. And accountants could work as auditors, they could work as a taxman, but they need to have some general understanding of what accountants do and the world of financial accounting. But moreover, accountants do the accounts for a business. So we need to learn the types of businesses that are in your syllabus, because we need to know the difference between sole traders and shareholders. So we'll start off with sole traders. A sole trader is a business that is run by an individual. Okay, a sole trader is where you've got a business run by an individual. So sole means one, sole trader. So one person is running their business. But the sole trader can have employees, can employ people, okay? But this sole trader is only the sole owner of the business. And sole traders are very important because in the eyes of the law, the person who owns the business and the business are legally the same entity. So in the eyes of the law, the business and the person are the same. If we look at the business, we're looking at the sole trader. Now what this means, that if the business is in trouble, it means the individual is in trouble as well. So we say that the sole trader is personally liable for the business debts. So the sole trader has to reach into their own pockets and bail the company out. If the business is in trouble, then the individual is in trouble. If the business is doing good, then the owners are doing good as well. So the sole trader is an individual who runs their own business. And you can see many sole traders on social media these days, for example Instagram, and those who work on Etsy, and many social media pages, which you've got these people working from the comfort of their own home and promoting their business. Now sole traders they have full liability. They have full liability of the business debts. And sole traders can take out something known as drawings. Sole traders can take out something known as drawings. So it could be the sole trader's sole income. And if the sole trader takes out goods or money for their own use, we say this is drawings. Another type of business could be partnerships. Once again, partnerships have full liability. Can you think of an example of a partnership? You can have an accounts firm. Or you can have a law firm where you've got partners joining together and they have built a business and they employ people. So a partnership is like a sole trader, but the only difference is run by two or more individuals. So the owners are known as partners. And you can have sleeping partners who just own the business and don't do anything, or you can have active partners who actually own the business and they play an active role in managing the company. And the best thing about having partners is that you can have more access to capital. So to start a business, you need capital. So you've got more people joining together, you can have more money in capital, therefore you can do greater things. But once again, the partners and the business are legally the same entity, meaning that in the eyes of the law, the individuals who run the business, who own the business, and the business are seen as one. So we say that the partners, once again, are personally liable for the business debts. Now in F3, you were required to know how partners do their accounts, but that's been removed from the syllabus. What you need to know is just what partnership is. And finally, we have the final type of business, which is the limited liability company. A limited liability company can be a private company, or it could be a public company. A public company is where the shares are traded on the market, but a private company is where the shares are not traded. We say that a limited liability company is an incorporated business. It's an incorporated business. And we don't have sole traders anymore. The owners of the company are known as shareholders. And the shareholders have limited liability. The shareholders are the owners, but they appoint directors to help run the business on their behalf. So it's run by directors. And in the eyes of the law, the shareholders and the company are separate. This is known as the separate entity concept. Meaning if the company is in trouble, it's the company's responsibility to help its way out. The shareholders only have a limited liability company. Limited liability, meaning they don't have to reach into their own pockets and help the company. They can if they want to, they don't have to if they don't want to. Now, shareholders receive something known as dividends. So it's up to the directors to run the company in such a way that the company is profitable, and any profits that the company makes may be distributed as something known as dividends. So dividends are associated with shareholders, but drawings are associated with sole traders. So there you have it, guys, the types of businesses. I'll be back in just 5 seconds. Okay, so welcome back. Now what we're going to do is look at the advantages and the disadvantages of incorporation. Now, if you now are an incorporated business, the main advantage is that the owner now has limited liability. Okay, so you don't have to bail the company out if the company is in trouble, and you don't have to risk your personal assets, meaning you don't have to be personally liable. And the downside, however, is that if you're now an incorporated business, you have greater admin costs. So you'll have to hire an accountant to produce financial information, and this needs to be filed into Companies House every single period. You now need to pay something known as corporation tax, and this requires further calculation and maybe a greater tax expense. And the advantage of being a sole trader is that you have a greater control over what you decide and what happens in your company. But if you then become an incorporated business, then it means you might have more shareholders, and that would be less control of your company. So let's look at the importance of financial accounts. Financial accounts is financial accounting. It's all about what has happened in a business over the past 12 months. So it's all historical data. Over a 12-month period. Okay. How often do we need to produce the financial accounts? Well, we need to produce them annually. We need to produce them every single year, and then we need to file them into Companies House. The legal requirement is required by law. These are statutory accounts, meaning that by Companies Act, we need to produce these financial information for the users. Format. There is a strict format to follow. And we have to follow something known as accounting standards. And accounting standards are created by the grandfathers of accountancy, and these guys sit and discuss and decide what the rules of accountants should be. There is no right or wrong rule, but if you want to be recognised by company law, then you must follow these accounting standards. Moreover, accountants must follow these rules because a company may be subject to an audit. And an audit is where you've got members of a team coming with a magnifying glass and following you around everywhere, making sure that you follow these accounting standards. And if you don't, they're going to snitch on you to the shareholders. So it's very important that we follow the accounting standards. So who would be the users of these financial information? Now we know that it could be the shareholders or the owners or potential owners of a business. Surely a business's goal is to be profitable, and the more profitable you are, the greater the return on your investment and the richer we become. So owners and potential owners would want to know the information given by accountants to see how well or bad the company has performed. You can have employees. Employees would want to know how well the company's performed, because the greater the profit, and it's more likely there's going to be a pay rise, or one can hope for a pay rise. Or you can have more established companies which offer a pension scheme, and we want to know how or what effort or what extent this company is going to create something for the future of employees. You can have the government. Well, the government is interested because the greater the profit, the greater the tax you'll have to pay. The government is also interested in where you're opening your shops or where you're basing your headquarters, because you may wish to be, be advantageous to them because you may create jobs in that area, or they may say, here, take $100,000, open a factory in no man's land, and maybe those areas which have unemployment rates which are high, you may create jobs in that area. You can also have, let's say, governments which, departments in the governments which test you if you're being environmentally friendly, for example. Customers may be interested in financial information. For example, BHS, well, if there is a sale, would love to know. But more importantly, you can have suppliers who are interested in financial information. Because what is a supplier? A supplier is someone who sells you goods. And if they want to sell you goods, they'll only sell it to you if they know if you've got enough money to pay them, and if you pay other suppliers on time as well. If you don't pay me, then how is that beneficial to me in any way? So suppliers want to know if the company is able to pay them back. So there you have it, guys. We have financial accounts and the users of the information, and that is the end of chapter number 1. Well done. In about 5 seconds time, I'll see you at the beginning of chapter 2. Thank you very much, and see you soon. Okay then, so to summarise what we have done in chapter 1, what I would like to do is turn to our sample papers and try question 3 and question 4. Okay, I would like us to try question 3 and, not question 4, question 11, sorry. So please turn to your sample papers and we can start question 3 first of all. Which of the following statements are true of limited liability companies? Which of the following statements are true? 1. The company's exposure to debt and liability is limited. The company's, let me try that again. The company's exposure to debts and liability is limited. This is false. A company will have an unlimited amount of liability and an unlimited amount of debts. It's not limited. It's the shareholders which have a limited liability, not the company. So this statement is false, which means A and B and D is not correct, meaning C is the answer, right? Let's see why the others are true or false. Statement 2. Financial statements must be produced. This is true. If you are an incorporated business, or if you're a limited liability company, then you are required by law to produce financial statements and file them in Companies House. Statement 3, a company continues to exist regardless of the identity of its owners. This statement is true. This is the separate entity concept. It doesn't matter who the owners of the company are. The company and the owners are separate. So if the company had 0 shareholders, the company will continue to exist. So that means that statements 2 and 3 are true. So the answer is C for Charlie. Let's move on to question 11. Here you go. Question 11. And I will give you around 30 seconds to have a read, and then we'll do this one together. Okay, so question 11, it says, which of the following are differences? Which of the following are differences between sole traders and limited liability companies? 1. A sole trader's financial statements are private and never made available to third parties. A company's financial statements are sent to shareholders and may be publicly filed. Okay, now this is not a difference, this is just stating facts. So this is not a difference. Okay. It's really not, I'm just thinking about it. It's not a difference, it's just stating facts that, yes, this is what a sole trader does and this is what a company does. Okay? So A and D is not the answer. 2. Only companies have share capital. This is true because companies have shareholders, so they'll have share capital. But sole traders don't have any share capital. So, okay, we know that 2 and 3 is one of the differences. A sole trader is fully and personally liable for any losses that the business might make. This is true because it means that the sole trader and the business are the same entity, but whereas the shareholder and the company are not the same entity. And 4, drawings would only appear in the financial statements of a sole trader. This is true. A sole trader has drawings and a shareholder has dividends. So 2, 3 and 4 are correct. So that means the answer is B. So there you have it, guys. 2 questions that summarizes what we have learnt in chapter 1. Now what we're going to do is move on to chapter number 2. Okay. Now chapter 2 has around, once again, 1 or 2 questions in the exam, so we need to know it very well. And chapter 2 is all about financial statements and what the financial statements look like. Now remember we said that accountants must summarise the financial information on statements, and in this chapter we're going to introduce to you to only 2 statements, and the other 2 will be done in separate chapters. So we'll start off with the statement of profit or loss. We shall start off with the statement of profit or loss, or the SPL. This statement shows all the income generated by a company, shows income generated minus expenses incurred. All right, so it shows all the income minus all the expenses. Now, income is all the increase in benefits that you get from selling the goods or other ways that you can have benefits. For example, let's pretend that I am a shoe shop. The shoes that I sell is known as my revenue. But if I have another building, if I own another building which I rent out, then the rent that I received is known as my rental income. So there are many ways that I can generate income. But expenses are amounts of money that I must spend in order to help run my business effectively. Example would be if I buy shoes from my supplier, I need to buy shoes before I can sell shoes. Or if I have a shop, I need to pay for that rent in order for me to use the shop. So expenses are amounts of money that you must spend in order to help you run your business. And here is the general format of the statement of profit or loss. We start off with the revenue. And revenue is the income that you make from selling goods or services. Okay. And underneath revenue, we have something known as cost of sales. Cost of sales is very important. Very important. It's an expense. It's a very important expense. And the cost of sales aims to show how much money did you spend in order to make that revenue. To calculate cost of sales, we do this by calculating this very important formula. We start off with opening inventory, how many goods you had at the start of the period. You add on your purchases, meaning how many goods you bought during the period, and you add on any carriage inwards. Carriage inwards meaning postage and packaging costs that you paid to bring the goods towards you. But you minus any closing inventory. Closing inventory is the goods that you have left unsold at the year end. Because you haven't sold them, they cannot be included in this calculation. So you see, these are deducted by the use of brackets. Now, if you add down this column, you have your cost of sales to be 118,662. That's an expense. So expenses are taken away from revenue, and then you get something known as gross profit. Gross profit is the profit that you make strictly from buying and selling goods. So this company has made a gross profit of 114,338. And underneath the gross profit, we have all the other types of income and all your expenses. So underneath gross profit, you have other income. You have discount received. We'll see this in chapter 9. Okay. You have other income. Examples of other income could be rental income, could be commission income, could be bank interest, okay, it could be disposals. We will see other types of income throughout this syllabus. And then underneath that, we have our expenses. And remember, expenses are items which reduce your income. So income increases your profits, but expenses reduce your profits. So you've got examples of expenses, discounts allowed, which is the opposite of discounts received. We'll see that in chapter 9. Depreciation, we'll see that in chapter 6. Gas and electricity, we'll see that in chapter 7. Irrecoverable debts, chapter 5. Loan interest, chapter 14. Then we've got carriage outwards. Well, this is the opposite of carriage inwards. Carriage outwards is postage and packaging costs that you need to spend in order to send the goods to your customer, delivered to your customer. So carriage inwards is a part of cost of sales, but carriage outwards is part of the other expenses. And then you've got the boring ones, your water rates, advertising, and any other expenses. If you add up all the expenses, you get a total expense of 71662 in brackets to show your profit's going to be reduced. So this total 123449, take away your expenses, it gives you a positive number 51787, which represents the profit for the year. If it was a negative number, then that would be a loss for the year. So there you have it, the statement of profit or loss. It's important that you learn the format of this statement because you need to know what items go where. So income and expenses go to the statement of profit or loss. But now we will look at another statement known as the statement of financial position. So on the next page, we have the statement of the financial position, abbreviated to SFP. Now, the statement of financial position was also known as the balance sheet. The statement of financial position is also known as the balance sheet. And the reason why it was called that, because it shows that the assets of a business is equal to the capital of a business plus the liabilities of a business. Okay? So at any point in time, all the assets will be equal to the value of capital and liabilities, and they should balance. That's why this was known as the balance sheet. But now let's look at this statement in detail. The very first thing we see is the assets of a business, okay? And the assets of a business are where we have items that the business owns. Assets are items a business owns and used to generate future economic benefits. Assets are things that we own to help generate future economic benefits. What do we mean by benefits? You can either make money or you can either save money. So assets are items that a business owns. Now, assets can be split into two categories. We can have non-current assets or we can have current assets. It's important you know which assets are categorized at what. Non-current assets are assets which are going to be used by the business for more than 12 months. For example, you have property, land and buildings. You have plant and machinery. If you are a manufacturing business, you may have plants which help make your product. You can have motor vehicles. Let's say you own a delivery van. You expect to use that for at least a year. So all of these are non-current assets. Now, non-current assets on the statements of financial position must be calculated in this way. They must be calculated by taking cost minus depreciation, and that gives you carrying value. And we'll look at all of these calculations when we move on to chapter number 6. So that's your non-current assets. Then we have our current assets. Current assets are going to be used by the business within 12 months. Okay? For example, you have inventory. More importantly, this shows closing inventory. So if you have any inventory left over at the end of the year, then that is your asset because you expect to sell that when the new year comes. You have trade receivables. This means money owed by customers. Trade. When you trade in something, it means you're buying and selling. But if it's a receivable, listen to the word, trade receivable, meaning you expect to receive some money from someone. So a trade receivable is an asset. You have prepayments. I'm not going to say much about prepayments. I'm just going to say that this is going to be in chapter number 7. Okay? And you have the last current asset, which is cash at bank. So money in the bank belongs to you, and then you can have access to that whenever you want. So that's cash at bank. So your total current assets is 32752, and your total non-current assets is 184490, and your total assets come up to 217242. So that's your assets done. And then we show the capital of a business. Now, the capital of a business reflects the owner's investment. In a business. Okay, the owner's investment in a business. And capital is once again a very important formula. So you have to learn this. How we calculate capital, we do this by taking opening capital, how much they previously invested, and we add on any further capital introduced during the year. So if they've invested more money into the business, we add that on to opening capital. Then any profits that the company has made is going to capital because it's a return on the owner's investment. Do you remember on the SPL we made a profit of 51787? That's going to be shown in capital here. But then we have takeaway drawings. Emphasis on the brackets around drawings. Do you remember we discussed drawings in chapter 1? Drawings is when a sole trader takes out money or goods for their personal use. So that reduces the amount of investment they made. So your total capital comes up to 168352. Underneath capital, we then show liabilities. And a liability is an obligation which will result in an outflow of benefits. Okay. Liabilities are obligations. So I'll simplify it down to money owed to third parties. So a liability is where you owe money to other people. And once again, liabilities are split into two categories. You can have a non-current liability or a current liability. A non-current liability is one which you'll have to pay back in more than 12 months' time. Whereas a current liability is one that you have to pay back within 12 months. Okay? So an example of a non-current liability will be a loan. You have to pay back $20,000 in 5 years' time, let's say. But a current liability, you can have an example, trade payables, which is the opposite of a trade receivable. A trade payable, listen to the word, payable, is money you are yet to pay your suppliers. So money owed to suppliers. And then another current liability will be accruals, but I'm not going to say much about that. We say chapter 7. So you add it down. Your non-current liabilities is 20,000. Your current liability is 28,890. So total current liabilities and your non-current and capital, 217,242. And you can see, ladies and gentlemen, that this is exactly the same number as we got at the top. So this number, 217,242, matches this number. So the balance sheets balances. In the exam, however, you're not going to be asked to produce a full statement. You're going to be asked to do bits of it. So, for example, can you calculate a prepayment? Can you calculate the capital? Can you calculate the trade payable? So you are going to be expected to know how to do the tiny bits. So this balance sheet derives from the accounting equation that all the assets of a business must be equal to the liabilities and the capital of a business. This is known as the accounting equation. The accounting equation is assets is equal to capital plus liabilities. So it's an equation. You have a left-hand side and a right-hand side, and it must balance every single time. So if assets go up, if the left-hand side goes up, then the right-hand side must go up as well. Or if the left-hand side goes down, the right-hand side must go down as well. Or if the left-hand side goes up, then it must come back down again. It must balance at any point in time. This is the accounting equation. And we can extend this accounting equation. We can extend it because we know how to calculate capital. We know how to calculate capital. So the extended equation is that your assets is equal to opening capital plus capital introduced plus profits minus drawings plus liabilities. Okay, this is known as the extended equation. All I've done is extend what capital is. We know that opening capital plus capital introduced plus profits minus drawings can be calculated using that formula, capital. So I'm just extending it. So you might get a question in the exam where they've given you the extended equation all muddled up and you have to unbundle it and see what the right equation is. I've set some questions from the question bank and the sample paper and the revision kit so you can practice that. So please make sure you have a go at that. But what we're going to do now is prove to you that the accounting equation always holds true no matter what. And in order for it to hold true, two things must happen. And this is known as the dual effect. What comes up, something else must come up as well. Or if one thing goes up, that same thing has to go back down as well. This is the accounting equation. So we start off with this example, Terry. Show the accounting equation for Terry at the end of the week. So the accounting equation is that assets is equal to capital plus liabilities. I'm going to show that the accounting equation is going to be balancing no matter what happens. So we've got Terry is a sole trader and commences business on July 15. The following transactions took place during his first week of trading. So on the 1st of July, Terry put $20,000 cash into the business. So Terry is investing money in his business. If you invest money, this is known as capital. So Terry's capital goes up. But where will this cash go? This cash is going to go into the business's bank account, and the bank account is an asset, so the asset goes up as well. So for the first week, the 1st of July, Terry's asset goes up by $20,000 and the capital goes up by $20,000. There are no liabilities, I'm going to put a 0 there. So you can see that the left-hand side and the right-hand side is equal. Second one, on the 3rd of July, Terry purchased a motor vehicle for use within the business for $9,500. Terry purchased a motor vehicle. So you now own that motor vehicle, and something that you own is an asset. So Terry's assets will go up. But they bought that motor vehicle with $9,500. Where would that $9,500 come from? It would come from the money in the business's bank account. So the money out of the bank will go down. So Terry's asset will go back down again. So on the 3rd of July, assets goes up by $9,500 because you now have a car, but then your bank account balance will go down. So nothing happens to capital and nothing happens to liability. You can see the left-hand side and the right-hand side are equal. And then finally, on the 7th of July, Terry takes out a 5-year loan from the bank for $5,000. If you have a loan, it means you owe the bank money. And if you owe someone some money, it's an increase in your liability. And if you borrow $5,000, where would that $5,000 go? It would go in your business's bank account, which is an asset. So your assets go up. So assets go up by $5,000. Nothing happens to capital, but your loan or your liability goes up by $5,000. So you can see, ladies and gentlemen, that at any point in time, your accounting equation holds true. But accountants really do not use the language of accounting equation every single time, because it could be a very, very long equation because many things happen in a business. So accountants like to summarize it by using the rules of double entry bookkeeping. We're using debits and credits to understand what has happened in a business. Now, before we look at debits and credits, on the next page, it's fundamental accounting assumptions. This one I'm going to set for reading homework. Now, reading homework doesn't mean that it's not important. It's very, very important, and questions on this may come up as theory questions. Okay, so it's very important that you read on these assumptions, because you will definitely get questions on these. Now, you can read more about it on the study manual, which is available on Canvas. So here you have 1, 2, 3, 4 assumptions that you must learn and know the definitions of and the names if you recognise them in the exam. So there you have it, guys. That is the end of chapter number 2 with additional reading homework, and I'll see you in 5 seconds when we start chapter number 3. Thank you very much. Okay, so welcome back. What we're going to do now is start debits and credits, which is double entry bookkeeping. So what we need to do is record financial transactions. We record them, we list them down. But once we're ready to present the financial information, we need to use debits and credits as a way of explaining what has happened in this particular transaction. Now, we enter debits and credits into something known as ledger accounts, okay? Now, I want you to imagine this in your head. I don't want you to think about accounting, computer accounting. I'm talking about very old traditional accounting. So when we were doing manual accounting, we used to have a book. This book used to be called a ledger. In this ledger, you have something known as accounts. And the accounts looked like the letter T. So you can see here is an example of an account, the letter T. Now, we will have an accounts for each asset, each type of liability, each type of income, each type of expense, and one account for capital. So we will have many accounts, and in these accounts we have two sides. We have a debit side, which appears on the left, and a credit side, which appears on the right. Now, it's the rules of debits and credits which tell you which side something should appear in. So if something is on the debit side, it could mean that something has gone up or this particular account has gone down. But if it appears on the credit side, it means something in this account has gone up or something in this account has gone down. So do you see that it depends on the rules of debits and credits on which side of the T account we enter these things in. And each transaction will have one debit entry and another credit entry. And they must always be equal in total. So now let's see which items are debits and which items are credits. The best way to remember it is to learn the mnemonic dead, click. Dead, click. Meaning that expenses, assets and drawings are all debit accounts. If you want to increase any of their values, you show the transaction on the debit side. But if you want to decrease any of their values, you show the transaction on the credit side. So if you want to increase any of the, didn't mean to do that. If you want to increase any of these, you debit their accounts. But on the other side, you have click, which means that your credit accounts are liabilities, income, and capital. Meaning if you want to increase any of these, you make the transaction appear on the credit side. But if you want to decrease any of these, you make the transaction appear on the debit side. Okay, so I know it's a lot to take in, so let's have a go at an example. Okay, so for example, Reg bought a car for $5,000. Okay? Reg bought a car for $5,000. A car is an asset, so my asset has gone up. So to increase an asset, you debit that asset. But this 5,000 has come out of my bank account, and this bank is an asset, but my asset has gone down, so you credit that asset. So the double entry would be to debit car 5,000 and credit bank 5,000. Which means that this will affect the car T account and the bank T account. In the car's T account, you enter the transaction on the debit side, but in the bank's T account, you enter the transaction on the credit side. Let's have another example. Let's say Reg sold goods for $100 on credit. What does that mean? If you sell goods on credit, what does that mean? A credit sale is different from a cash sale. A cash sale is where the customer immediately pays you, but a credit sale is when the customer will pay you later. So I sold goods. If you sell goods, this is a type of income. But if you're selling goods that you trade in, this is known as sales or revenue. And if your income goes up, according to Dead Click, you credit the income accounts. So credit sales by $100. But what do we debit? If the customer has yet to pay you, it means that you have money owed by your customer. And a money owed by customers is known as trade receivables. And we've seen that trade receivables is an asset. So your asset has just gone up. And to increase assets according to Dead Click, you debit the asset account. So debit trade receivables $100. So there you have it, guys. These are examples of double entry. And you need to ensure that you learn the language of Dead Click in order for you to excel in all the questions that we are going to be doing from now on out. Okay? So what we are going to do is have a go at the example on the next page, example 1, where we have to do something for George. It says required. For the first 2 weeks of trading, prepare the journal entries, the ledger accounts, the trial balance, that's something new, the statement of profit or loss, and the statement of financial position. Okay, so I will be back, guys, in about 10 seconds, and then we are going to be doing this together. So I'll see you very soon. Thank you. Okay guys, so welcome back. What we are going to do is do the journal entries for George. George commences business on the 1st of April 16. The following transactions take place in his first 2 weeks of trading. So on the 1st of April 16, he invests $50,000 into a business. So what would be the double entry? If you invest money in a business, capital goes up. And if you put money in a business, it will go into the business's bank account, so the assets will go up. So we'll have to do a debit and a credit. Well, according to Dead Click, to increase your asset, you debit. So you debit the bank account by $50,000. And then what you do, you credit capital by $50,000. Okay? So what we are going to do then, we are going to open up a T account for bank and capital. So on the next couple of pages, you will have a very empty T accounts, and we're going to fill in these ourselves. So we'll have one account for bank and one account for capital. Now what I'm going to do is ensure that you remember which statements these accounts belong in. Bank is an asset, and assets belong to the SFP. Capital represents owner's funds, and owner's funds appear on the SFP. So what we're going to do then, the first entry was to debit bank, credit capital. So on the debit side of bank, you enter a transaction, and this is what it looks like. You'll write capital, 50,000. And then on the credit side of capital, you write bank, 50,000. So we write a description as to where this money has come from. So it's telling me, the bank account is telling me that I've had an increase of 50,000. That's because someone invested money in the business. Okay? So each T account is telling you a story. Let's move on to the next one. Let's go back. On the 2nd of April, he purchases $5,000 worth of goods for resale on credit. Okay? If you buy goods for resale, this is known as a purchase. Okay? And purchases are a part of the cost of sales expense. So purchases are expenses. So if you buy goods for resale, your purchases go up. But then you bought these goods on credit. If you buy goods on credit, it means you owe your supplier some money. And if you owe your supplier some money, it means you have a liability. So, your expense has gone up and your liability has gone up. According to Dead Click, to increase your expense, you debit, but to increase your liability, you credit. So which accounts will we debit and which account will we credit? Well, if you buy goods for resale, this is known as a purchase. So you debit purchases for 5,000. Okay? And if you buy goods on credit, it means you owe your supplier some money. And if you owe your supplier money, this is known as a trade payable. So you'll have a trade payables account. 5,000. So what we're going to do on the next page is open up a T account for purchases and trade payables. So we have a purchases account. And purchases appear on the SPL because it's an expense. And on the next page, we'll have a T account for trade payables. Trade payables is a liability, so that will appear on the SFP. So the double entry stated that on the debit side of purchases, I have to debit purchases, so trade payables, 5,000. Okay. And on the credit side of trade payables, I have purchases, 5,000. So we need to ensure that we have everything all going to the right place and on the right side of the T accounts. If you have not put it on the right side, then your balance sheet won't balance. Let's carry on. Let's go back. On the 3rd of April, he sells half of his goods for $6,000 cash. He sells. If you make a sale, that means you've increased your income. To increase income, you credit. But if you sell goods for cash, the cash will immediately go into your business's bank account, so your asset will go up. And to increase assets, you debit. So what you'll do, you debit your bank, 6,000, and then you credit sales, 6,000. Okay? There you have that. And then we already have a bank account open. Now we're going to open up a sales account. Okay? So we have a sales account. Sales represents income, and income appears on the SPL. So the double entry was to debit bank. So on the debit side of the bank account, on the previous page, on the debit side, I write sales, 6,000. And on the credit side of the sales account, I write bank, 6,000. Bank. $6,000. Okay? Next ones. On the 4th of April, he issues a check to pay for the goods he received on credit. Okay? Do you remember on the 2nd of April, he bought goods on credit? Now on the 4th of April, he's paying his supplier back. If you issue a check, meaning the money is going to come out of your bank account, so your asset will go down. But then, on the 2nd of April, you created a liability. You've paid this person off, so it's no longer a liability, so you need to remove that liability. And to lower a liability, according to Dead Click, you debit. So debit trade payable, 5,000, and then the money will come out of the bank, credit bank, 5,000. We have these two accounts open, so let's enter these straight away. Trade payables, on the debit side you write bank, 5,000. Do you see here, ladies and gentlemen? You see that on the credit side you had a liability, now the liability is gone because you paid them off. And then go to bank on the credit side, trade payables, 5,000. Okay. Let's do another double entry. On the 5th of April, he pays his rent for April of $450 by check. Rent is a type of expense, so your expense for this month has gone up, but then you're paying by check, meaning that your bank account value has gone down, so your asset has gone down. So to increase an expense, you debit, but to decrease an asset, you credit. It's all about dead click, guys. So debit rent, expense, $450, and credit bank, $450. Okay, we have a bank account open, but not a rental expense account. So let's do that then. Expenses appear on the SPL. Okay, so on the debit side you have bank, what was it, $450? Okay, and then on the credit side of bank you write rent, $450. There you go, well done. This is all bookkeeping we're doing. Let's do another double entry. On the 6th of April, he sells his remaining goods for $6,000 on credit. Okay, he sells on credit. If you sell goods on credit, it means the customer hasn't paid you. They will pay you later. So if money is owed by customers, this is a trade receivable, which is an asset. And if you sell goods, this is an income. So George's asset has gone up and his income has gone up as well. To increase assets, you debit, but to increase income, you credit. So debit trade receivable by $6,000 and credit sales by $6,000. Okay, I think we have a sales account open, but not a trade receivable account. So let's open one now. Yeah. Trade receivables are assets, and assets appear on the SFP. Okay, so on the debit side, you have sales, $6,000, but on the credit side of sales, you write trade receivables, $6,000. There you go. Okay, so just checking my calculator. Let's do another one here. On the 7th of April, he purchased goods for resale on credit for $7,000. Okay, if you buy goods for resale, this is known as a purchase, which is an expense, so your expense goes up, but you bought goods on credit, meaning you owe your supplier some money. And if you owe your supplier money, that's a liability, so trade payables go up. So increase your expense first. Debit purchases, $7,000, and credit trade payables, $7,000. Have a go at entering this in your T accounts, and then I'll be back to see if you've got it right or wrong. Thank you. Okay guys, so welcome back. Let's see if we've entered those correctly. On the debit side of purchases, you need to write trade payables. Which are $7,000 here. And then we have on the credit side of trade payables, on the credit side purchases, 7,000. Okay, and that's that. And then we have on the 8th of April, he purchases a delivery van for $7,000 cash. Now, when students see the word purchases, they think, it's a purchase. But a purchase is where we buy goods for resale. This is just a purchase of a motor vehicle, which is a non-current asset. So you can't debit purchases, okay? So if you buy a delivery van, your assets go up. But then if you bought it for cash, meaning the bank account balance will go down. So asset goes up and then it comes back down again. So what you will do is debit motor vehicle, $7,000, and then you credit bank, $7,000. Okay. Now we don't have a T account for motor vehicle, so let's open one up. Here we go. Motor vehicle. And it's an asset, so it will appear on the SFP. On the debit side, you have bank, and that was 7,000, wasn't it? Okay. And on the credit side of bank, you have a motor vehicle, 7,000. Anyways, so we have now just completed all of the double entries and we've entered the transactions into the ledger accounts. Now the next thing we do is we balance the T accounts and the balancing figures go to the trial balance, okay? The trial balance is something we'll look at in a minute, but before we do that, what I want to concentrate on is balancing the T accounts. Now, we have seen everything that's happened in the first 2 weeks of George's trading, but now we want to know how George is doing. So what we need to do is balance these accounts, and it's a very simple process. But one thing you have to remember is that with SFP accounts, you will have a closing and an opening balance, but with SPL accounts, you just have a closing balance, that's it. All right? So let me show you how to do bank. What you do is you add down both columns, deciding which column has a higher total. So you can see clearly that the debit side had a higher total. So we write 56,000, 56,000. Okay, so the debit side adds up to 56,000, but the credit side does not. The credit side only adds up to 5,000 plus 7,000 plus 450, which is 12,450. So we need to add an extra balance to make it add up to 56,000. So 56,000 take away this is 43,550. This is known as the balancing figure. So the balance carried forward is 43,550. If you see what it's doing something very clever. Bank is an asset. So we debit anything that increases bank and credit anything that decreases bank. So this tells us how much money is left over in the bank account at the end of the 2-week period. So on the 9th of April, we bring it forward. Balance brought forward, 43,550. So on the very next day, George has 43,550 in his bank account. That's how you balance a T account. Let's do capital. What you do, you add down both sides and decide which had a higher total. Clearly, the credit side is higher. So you have a 50,000 here and a 50,000 here. But the debit side adds up to 0. So what you need to do is add extra items to make it add up to 50,000. So we have balance carried forward, 50,000, and a balance brought forward on the opposite side, 50,000. Do you see that capital is a credit account, and you see the balance brought forward appears on the credit side. Purchases is an SPL account. An SPL account does not have an opening and a closing balance. What we do instead is we clear the accounts, and this account is going to start from 0 from the 9th of April. So what you do, you have 12,000, 12,000, okay? So your balancing figure is simply going to be called expense to SPL. Oops. If I can type. Expense to SPL, 12,000. And that's it. We've closed the account, and tomorrow we're going to start counting from 0 again. Let's carry on. Trade payables is an SFP account, so we'll have an opening and a closing balance. The higher total is 12,000. 12,000. But the extra money needed to be added on is 7,000. So you have a balance carried forward, 7,000, and a balance brought forward, 7,000. Okay, so it means that we still owe our suppliers $7,000 from last 2 weeks. Sales is an SPL account, so we are not going to have an opening and a closing balance. So we have a 12,000 here, 12,000 here. So what we do, we write income to SPL, 12,000. So we cleared the account, and we're going to start counting from 0 from the 9th of April. Rent expense, again, is an SPL account, 450, 450. So we have expense to SPL, 450. So the account is cleared, and that's it. Let's carry on. Trade receivables is an asset, so we'll have to have an opening and a closing balance. 6,000, 6,000. We balance carried forward, 6,000. Balance brought forward, 6,000. Okay, so the trade receivables means that our customers still owe us 6,000 from 2 weeks ago, so we can't forget about it. We need to catch up and chase after the customers so they pay us. And motor vehicle, finally, we have 7,000, 7,000. Motor vehicle is an asset, so we are going to have a balance carried forward, 7,000. And a balance brought forward, 7,000. So we bought a motor vehicle in the last 2 weeks. We're going to have to depreciate it so we can't forget about the car, so we need to bring it forward every single year. So there you have balancing the ledger accounts. Now the balancing figures is what we show on the trial balance. So a trial balance, we have an example of that on the next page. Here we go, trial balance. A trial balance is made up of 2 columns. It has a debit column and a credit column. A trial balance simply acts as an arithmetical check that all debits equal to credits. It doesn't point out your mistakes, okay? Doesn't point out mistakes. You can still make a mistake and your trial balance will still balance. If your trial balance doesn't balance, then it's obvious that you've made a mistake. But if your trial balance does balance, it just means that your debits equal to your credits. It doesn't mean that you haven't made a mistake. So what we do, we go through all the accounts in the ledger and the balancing figures appear in the correct column. So if it's an asset, expense or drawing, it will appear on the debit column. But if it's an liability, income or capital, it will appear in the credit column. Okay, so here we have, starting with bank. Bank had a balance of 43,550 and bank is an asset, so that will appear on the debit side. Capital had a balance of 50,000, which is a credit balance. Purchases is an expense, so that will appear on the debit side of 12,000. Trade payables is a liability and we owe our suppliers 7,000. Sales is an income, so it's credit and we've sold $12,000. Rent is an expense, which is a debit, so that's 450. Trade receivables is an asset, that's 6,000. Motor vehicle is an asset, and that's 7,000. Okay? If you add down both columns, they should come up to the same total. That's how you know your trial balance balances. So if you add down, $69,000. So both of these, 69,000. Okay. So there you have it, your trial balance balances. And before we start producing the income statement and the balance sheet for George, we need to do one extra step known as the closing inventory journal. Okay. So how much inventory does George have left over at the year period end? Okay. So you can see that on the 2nd of April, he purchases $5,000 worth of goods. So his inventory value now is 5,000. But then on the 3rd of April, he sells half of his goods for 6,000. The half that he sold, what was the value of those goods sold? Well, it's going to be half of 5,000, so you take away 2,500. Okay? Then, on the 6th of April, he sells his remaining goods, meaning his inventory value goes down by 2,500. And on the 7th of April, he purchased goods for resale on credit for 7,000, meaning his inventory value has gone up by 7,000. So if you add down that column in red, what's the closing inventory? What is the closing inventory? What is the value of the goods left unsold at the year end? 5,000, take away 2,005, take away 2,005, add 7,000 is $7,000. So George's closing inventory is $7,000, and closing inventory is important because it's a part of cost of sales and a part of current assets. So now that we've established all of that, now what we're going to do is prepare George's statement of profit or loss and George's statement of financial position. I'll give you guys 5 seconds to get ready and then we'll make a start. Thank you. Okay, welcome back. So what we are going to do then is go on to the next page here, George's statement of profit or loss for the 2 weeks ended April 16. We'll start off with sales, and sales is the income. Now do you see there's 2 columns here? Now a lot of people think debit column, credit column. No. This is the total column, and this is just a breakdown column, okay? And I'll show you what I mean. You start off with sales, a total sales of 12,000, that goes here. Then you have cost of sales, and cost of sales is calculated by doing this calculation. Opening inventory. Opening inventory is 0 because George commenced his business. He made purchases of 12,000 and his closing inventory is 7,000. We always take away closing inventory because it's unsold. So the total here, 12,000 take away 7,000 is 5,000. So his cost of sales expense is 5,000, and therefore gross profit, sales minus cost of sales, is 7,000. Okay. Now underneath gross profit we show any other types of income. George has no other type of income, so that's 0. But then we show our expenses. The only expense George has is a rent expense of 450. So then that will give you a profit. 7,000 take away 450 is $6,550. And there you have it, George's statement of profit or loss. Very nice, very easy. Let's move on to George's statement of financial position. Now, this is also known as the balance sheet, meaning that the assets must equal to the capital plus the liabilities. So George's statement of financial position as at April 16. So we start off with the non-current assets. The only non-current asset George has is the motor vehicle of 7,000. It costs 7,000. We haven't depreciated it yet, so that's going to be 0. So the carrying value is 7,000, complete. Then we've got current assets made up of inventory. Remember, inventory is the closing inventory. What was the value of the inventory left unsold at the end of the 2-week period? It was 7,000. So 7,000 here. Trade receivables is 6,000. Cash at bank was 43,550. So the total current assets is 56,550. So your total assets, 56,550 at 7,000 is 63,550. There you go. That's your total assets. Then we do capital. Capital is calculated by opening capital plus capital introduced plus profits made minus drawings. The capital introduced by George is 50,000. The profits made was 6,550 from the statement of profit or loss. There weren't any drawings because George did not take out any goods for his personal use. So the total capital is 56,550. Okay. Then non-current liabilities, there weren't any non-current liabilities, but we've got current liabilities, trade payables of 7,000. We had trade payables of 7,000. So if you add down 56 at 7 is 63,550. And if you notice, ladies and gentlemen, our balance sheet's balances. Total assets equal to total capital plus the liabilities. And there you have it, George's statement of profit or loss and statement of financial position. Now, you are an accountant. Accountants use double entry, summarizing on the trial balance and presenting information on the statements for the users of the information. We've done an excellent job on George, but for homework, you guys are going to do example 2, Tina. This is a very, very, very important piece of homework, and I expect everyone to have a go at this question and submit their answers to me. There are many ways you can do it. You can do it on Word, you can do it on Excel, you can do it on a piece of paper, and you can take a picture with your phone and send the pictures to me in an email. There are many ways that you can do your homework, and it's up to you to decide what you do best. But submitting homework to me is essential because then I can point out your mistakes and see how well or bad you are doing and show you where you need to do an improvement. Now guys, you have 2 pieces of homework from the class notes, the reading homework at the end of chapter 2 and this example 2, Tina. So please make sure that you follow what we've done in class and apply it to what we've done in the homework questions. You also have a list of questions to do from the sample paper, a list of questions to do from the revision kits, and a list of questions to do from the question bank. So please remember, if you've got any questions, you can always email me at ruddin@lsbf.org.uk. But for now, ladies and gentlemen, I wish everyone a lovely remainder of the week, and I'll see you next week. Thank you and goodbye.